Hello, everybody. So we are in our webinar for the Kids Saving Plan. I'm very excited to have you all here, and I'm very excited to share with you this fantastic plan that we have for the kids that is going to change the life of our kids so that they make the level of the stress for the kids and for the parents low. I'm very glad that you are here. And so we are going to start, and the more people is going to join all the way. And so before any further ado, let's just jump into that. So I have my co-host that is presenting to you some parts, Anand Murthy, that he is a partner of mine in the AGI and integrity that we are working. And we have all fantastic plans in the AGI and integrity. We have started this webinar for the kids, but we have other plans available that works for the parents, for any adult too, that can include the protection and also saving and growth of the money. So we're going to give you a brief about those ones first, and then we're going to go over the kids saving plan in the detail with illustration and everything. And at the very end, you can ask your questions. And after the meeting, I will give you the link for the calendar so that you can book an appointment for a one-on-one meeting, more explanation, answering all your questions, and also give you a personalized illustration for every single of your kids so that you can decide better when you have the numbers in front of you. So I'm not making you to wait anymore. And here is Anand is going to explain. Go ahead, Anand.
Thanks, Nadia. Hi, everyone. Thanks, Nadia. And today we know the session is more focused on the juvenile IULs, which are great wealth building vehicles for kids, which builds a great nest egg for kids, has a lot of flexibility. But before we go deep into that, just high level want to show the various financial solutions which we help families part of AGI integrity. We're a group of financial professionals, and again, any solutions we're talking about are from the top companies in America, like Nationwide, AIG, North America, Athene, Allianz, and top companies like that. So just high level talking on some of the important items which every family needs to have. Just like we have health insurance, which is mandatory, or even for a $10,000 car, we pay like $100 per month. Life is important. And when it comes to term life, it's income protection. It's not about only if something happens to us, money goes to the family. It's about if we are not there, whatever income we would have earned, that kind of money, how can it go to the family? So high level, better to always have individual coverage. Even sometimes you work with a company, you have like group coverage. Group coverage is typically very less, and also it's all about leverage, right? This is the money we have not saved. This is the legacy we're building for family, which we have not saved that much money for. And always, as we know, health cannot be guaranteed, life cannot be guaranteed. So whatever we can do, right? So that's where term life comes in, pennies on the dollar concept. And instead of paying additional, some people pay additional amount with the employer and say, just give me another additional 100K coverage. It's always better to take individual coverage. Why? Because when you change the company, coverage still stays. Even if you leave the country, coverage still stays as long as the money is being paid. And also, just like how mobile phones have evolved, even the solutions have evolved. So these comes with something called living benefits, critical, chronic, and terminal. So while we live, we can take money from that, right? And also, the term insurance can be converted to permanent insurance. And it's suggested by the industry that at least 10 times of salary we should be covering. Just thinking something goes wrong for the next 10 years, at least family doesn't have to worry about the money, right? So a big check comes to doorstep because we can't do anything about what happened in life, but at least financially, someone doesn't have to worry. And obviously, 10 times is suggested, but companies typically approve up to 20 times of our income. And this is used for legacy and obviously family protection, mortgage protection, living benefits, etc. And the next thing where Small item, but very important for every family is to have a will and trust, because as we know in US, every individual, I mean, every person is considered as a different individual. Even husband and wife, the doctors don't share information with other unless you have a HIPAA certification, or HIPAA approvals you are given, right? So just to ensure when something goes wrong, how does anyone know that what you would have intended, right? So instead of going through the probate process, so that's some another session we can have another day. If you have a will and trust in your name, the intent is already given there. So when if something happens, things go wrong, who gets the kids, what happens to all our assets, who gets what, all that will be clearly mentioned. And earlier there used to be like a costly affair, if you have to go to the attorneys. Now, because a lot of developments have happened, there are softwares which do that for just a couple of $100. It's better to just get it done. It's a peace of mind for the family. And then next one we do, again, we have a lot of solutions. High level, we're just trying to cover which are the essential ones. We have helped hundreds of families on this. One of the items is called indexed universal life. Earlier, people would have heard whole life, which are all the 20th century products. These are the 21st century products. In if you search in TikTok or YouTube or anything, typically you will hear these products as infinite banking concepts, and that's where this falls under. Where this can be used high level again is someone is trying to save money for kids' college, right? So 529 and all that stuff. So there money grows at a certain level. Instead, we can diversify into this vehicle. Money grows better than what it would have grown in 529. That's one place. Another place is people are trying to put money into their 401k in company. If there is a company match, it's fine. That means you got free money. But if you're simply putting money into 401k without a match, we are just putting our money at the risk of stock market. Instead, there are vehicles like this where you can put the same money. That's one thing. Third thing is we want to create our own pension plan, right? So there may be some money comes from SSN, whatever. But while we are earning, we want to pay ourselves first. Save a portion of the money for future, right? So that means every 100 we save now, how about it gives 300 in the future, month on month till we live till 100. So there are these three different places minimum where these diversification vehicles will be leveraged. Instead of max funding 401k, instead of putting money in 529, or instead of trying to save for retirement somewhere, money can go into these vehicles, and these vehicles have a lot of advantages. One is um, protection and leverage of life insurance. What it means is, other than the money we saved, that extra money always comes because it's tagged to a life insurance product, and money grows compounding, right? In this, and stock market type returns. Whatever money we saved, it is growing like how stock market grows, but it has a downward market protection. Means when stock goes down, unlike in our other vehicles, where if we had $1,000, stock goes down 20%, we become $800. That doesn't happen here, right? So there's a downward market protection because of a strategy called index strategy, which is used in the solutions, used by all the top companies in US. And also the best part is these are not 401ks. These are not IRS where you have to wait till 15 and off. Money can be withdrawn anytime for college or home down payment or retirement or anything, right? So you don't have to wait till 15 and off. And anytime you can just take up to 80%, right? Your money is your money. That's where infinite banking concept comes. We just suggest up to 80%. You can actually take a little more than 90% out. That little 10% we always keep it there because of the insurance component. If something goes wrong, you still need that big check, right? And also, not only it's like infinite banking, whatever money we withdraw is tax free anytime, or even if it goes as death benefit, it's tax free for beneficiaries. So like I said, there are various ways. Instead of putting in other vehicles, this can be leveraged. And the next one is, which will be more detailedly covered in the session today, is juvenile IULs, which are exactly this. Whatever I said here, it works this way. Awesome products, growing tax free, grows like stock market. Money never goes down, and there is extra money when things go wrong. You have access to money anytime and all that. But the advantage here is for kids also we can start this. Someone like a 1 month old can have this product, right? So the advantage here is we can start as small possible. And today's example, Nadia will show that how smaller we can start and the value we see. And not only will have a better accumulation for future, it has all the benefits are listed here. So this is a case where we know most of the parents will be doing something like a piggy bank to save for their future, or putting in Roth IRA or somewhere, right? So these are very good, awesome diversification vehicles in those cases where not only you started early, and just like think about a gymnasium, you had like 3 feet in front of you, the kids can flip once, right? But if they have 20 feet in front of them, they can flip multiple times. Similarly here, because we're starting early for kids, they have more opportunity for their money to multiply many times in their life. Again, when it comes to wealth building, there is no quick rich scheme, right? You need to have money, save the money, give some time for money to grow. Your money shouldn't go down when stock market goes down, and give enough time for money to compound. So all that is happening here. That's where the solutions come in. And today we'll focus more on juvenile IULs. And another very important place where we help people is uh, obviously ourselves and people around us are always changing companies, right? If you had 401k there when you change companies, or if doctors or other people who have 403bs, if they change their institutions, or business people have their IRA. So instead of having all their money at the risk of stock market, there are great vehicles which uses index strategy. But again, all the top companies, we work with top 6 out of top 8 annuities companies in US. They can diversify money into better vehicles where this is approved by IRS, right? So, and even when you move the money, you don't even have to declare in the tax that year. So they are that kind of approved by IRS. So when you move the money, if someone moves their 100k, for example, it's downward protected, means even if stock market falls down, it'll never go down. And the growth will be like stock market, but money will not go down when stock goes down. And also there are vehicles, some other day we'll cover the session where whatever money we put into those products, they have income for life solutions. That means till we live, whether we live till 90 or 100, the money keeps coming month after month after month. And there are vehicles where they have joint option also. Where if there are spouses, if there was like a 401k mode for spouse, money keeps coming till husband lives and till wife lives, just like creating our own pension. And another exciting news is whenever these rollovers are done, which is IRS approved rollover, not only money never goes down, growth better, there's a bonus added to the money we moved. So that means whoever we are going to help, they're building better wealth. So there are some awesome products here. We'll have various solutions, follow-up sessions, and different concepts. But today we'll be more focused on JUL and IUL. And you will see these are awesome products. These are some very good wealth building products for kid. So this is something as a parent we can start way early in life, not only help them build wealth, but also putting that habit way early in their life, right? So we started something, let them continue that, and they're going to have better financial freedom early in their lives because we started early as parents. So yeah, with that, I think I'll stop at this point, and I think Nadia can go further details on the juvenile IULs. Thanks, Nadia.
Thank you so much, Anand. That was great. That was a very good review for all the plans that we have that can help every family in many ways. Each one of them are essential, but we always start with the protection of the family that is essential, like will and trust and the life insurance. By the way, these are the cheapest one because those are like the will and trust. We are offering very good plans, very affordable one. We can talk about that in another session. And also for the life insurance, generally term life insurance, that is mostly the protection, are among the cheapest product that you can pay and get tons of protection for those ones. So now let's go to explain about the juvenile IUL, that it is for the saving plans. Okay, everybody, so let's go over the juvenile IUL, that it is, juvenile is for the kids, the younger people, as Anand explains about the IUL. Juvenile IUL has all the benefit of the IUL, Indexed Universal Life, but it is for the kids. That's for the kids saving plan. And these are just my credit and then email, and you can put a message here. So this plan works for the kid, and as it has all the good benefits of the IUL, but we start them from the earlier age, as the kids have more time from the, for example, the time that we started, they have at least 20 years or 18 years, about more depending on when they start. Therefore, they can get better result of this IUL. So what is our kids saving plan? As we already explained a little bit about that, it is called Juvenile, IUL, Juvenile Index Universal Life. Index Universal Life is, IUL is an Index Universal Life plan. And as to explain that one, these are indexed strategy. To explain more, most of the plans that we are offering to our clients are following index strategy. And index strategy are the ones that when you put your money into that one, they are using some index, but they are not following exactly only the stock market. And due to that one, they are able to offer you these index plans that when you get those ones, when the market goes up, they are giving you a good rate of the market. But when the market start crashing and going down, you're not losing money. You have grown before, and now instead of going down and become negative, you stay level at the level of the zero. So that's the index strategy that we are using in all the plans. And it's called universal because these ones have lots of flexibility that we are going to talk about. And on the other hand, they are also a life insurance. These are a life insurance that not only give the life protection, although we don't need much of the life protection for the kid, but the thing is that when they start early, they can get benefit of the plans that they got at early age, that they don't have any health problem, and continue that one in the adulthood age after 18, and they do not need approval after the age of 18, and they continue that. So as I was saying, for the life part of that, for the life insurance, this is a type of the life insurance that is not only for the life protection, but also it gives the cash value. And the cash value part is the main part that we are using that for the kids, but at the same time, we get the benefit of that being a life insurance because the government is provide some protection, like for example, tax benefit to that, just because it is a type of life insurance. So what is Juvenile IUL? Juvenile Index Universal Life solution on a juvenile insured that might be from the age of 15 days, like 2 weeks, to the 17 years, end of the 17 years.
Yeah, and just to add, there are only two items where IRS won't put you taxes on the growth. That's Roth IRA accounts and any insurance items. Everywhere else, wherever we have capital gains, we have to pay tax on that. But anything tagged to insurance, if you are growing money, cash value, and all that, we don't pay any tax on any of the growth. So yeah.
Very good. Thank you so much. So why to use juvenile IUL? What's the reason that we need that? Juvenile insurance is frequently sold as part of a combined financial plan of saving and insurance. So it has both of them, insurance and saving. And insurance is purchased on the lives of dependent children in anticipation of future insurance needs. So that's the whole point, to start early, to put the time in their favor. Instead of starting a plan after they start going to the work or even at the age of 18 or whatever, when you start early, you put time in your side. The time is passing anyway, right? So why not to use that as an kind of an ally, right? Which could include saving, education planning, and or protecting their future insurability. As I explained, that for the future, they do not need to get approved for their health. They just can continue this insurance that they have. So what does it do? This provides decades of flexibility. It can provide flexibility to help prepare for different life stages. So that's one good thing about the juvenile IUL. that it's not only for the time that they go, the 4 year or more that they go to the college. They can use it throughout the life. Establish a financial foundation for their child's future. They have some money. After the cash is accumulated, the same as the adult IUL, it acts as a personal bank for them. They have a bank that is working for itself, make cash and more cash and saving and growth for them. At the same time, they have access to that anytime that they want. They do not have to wait they become 18. They do not have to wait to the time that they go to the college. They do not have to wait for anything. Any time that they need, they can get money out of that. But they just look at that, how much money they have over there, how much money they want to get. It is better to get it out now or later and all those things, right? Such a bank, right? Personal policy could build a cash value that could be used for educational planning or funding or anything, actually. They can use it for a down payment of a house that they want to start getting separated, become independent. They can use it for example, expenses of their marriage later. And continuing through the life when they are 30, 40, all those ones, anytime something comes, they want to make a business. They need money, they get out of that. They get the loan out of that. And the good thing is that when the child enter adulthood, they gain ownership of their policy and start to take more control of their financial future. So in this way, not only they have the control, but also the parents, they do not have to put too much pressure on themselves or be worried that, I have to pay to the end of my life or something like that. So the other things, and finally, when they enter retirement, they can know that they're protected by the coverage their parent provided to them. And their cash values can be used for their retirement needs like predictable income. We're going to show you some illustration, the simple one and more complete one, to see that how easy it is to make the financial life of your kid completely protected throughout the life, from the beginning up to the end. And as I said in one of my videos, that you see here that protecting the kids and all this financial solution, it's not just for the money. It's not to have a luxury life. It's just for the health of our living, so that the level of the anxiety goes down when you are protected, when you have enough money, you have a financial support, and you don't be worried about that one. You can decide better, and your level of the anxiety is lower, not only for the kid, but also for the parents. And that starts working from the day that you are doing that. When you get that plan, from the first day, your level of anxiety is down. I'm saying that because I have done that, and I feel that decreasing of the pressure. And also, I have a great friend of mine and a partner, actually, that she's here, Blanco, that she's later going to come and explain that about the experience that she had, if she likes to explain about here. I didn't tell her before. But so she can talk about that one, but because she got those for her kids. So why IUL better than other plans? So the first thing, these are mainly to answer many questions that I know that the parents have. When I offer these ones, when the first thing that I hear from the parents, they say, we are all covered. We have other plans. We have this plan, that plan. I don't want to name them, but let's see why we believe that this is better than those ones. First of all, it has tax benefit. As Anand explained, you don't pay tax on the growth of the money. First of all, you put the money after tax on this one. So the money that you put in that is not paying tax over that at all, right? Because it's after tax money already. The good thing about the insurance plans is that, as I said, they are protected by the government. Therefore, you're not paying tax on the insurance plan. No matter it is a term life insurance or the indexed universal life, no, you do not pay over any money that beneficiary gets you after when you are not here, or over any money that has been accumulated as the cash benefit and they want to get it out, right? No other things except, as Anand explained, other than Roth IRA has such a benefit. None of the college saving plans that all the other parents may have has this benefit, right? It's already saving 40% of your money. So the next one is a fixed index plan that, as I explained, you never lose your money. Even when the market goes down, you may stay at the level of the zero. Your growth may be zero. You may not go add more money, but you don't lose any money either, right? You don't have that one with any of the stock market plan. All the college saving plans that you have, they are working with the stock market. When the market is going down like now, you will see that your 5 to 9 is going down. You're losing money. I have had my 5 to 9 3 times goes down during the 10 years that I was doing that. I had another plan also. This happens to that. Like I lost thousands of dollars on that one. But this one, it never goes. So just these two reasons by themselves, I believe that's enough for any parents to think about that. If they like to change what they are doing, or if not, they can keep that one and add these ones for their kids. The other thing is flexible. You choose how much money you want to pay each month and how long you want to pay. That I'm going to show you that you can say, okay, I want to pay each month 100, 150, 200, depends on how much you want to make your money grow. But pay attention that as it is a life insurance, it is not unlimited, the amount that you can put. It has a limit. That's why we try to make a plan for you to put the max amount that you are allowed to put that one without paying any tax. And you can continue as long as you want. You want to, your kid pays up to the age of 35, 40, 50, 60, whatever, right? You can decide. And later they can change it too. That's why it's in universal, that's flexible. Why is better? Again, the other reasons, it's not bonded to a specific usage. It's not just for the college saving. You can use it for any usage. And it's not linked to a specific time. You don't have to wait for a certain time to start getting money. For example, when the kids start a college, right? You can get it anytime that you need it. It grows even years after you have stopped paying. In the illustration that I'm going to show you, and Anand is going to show you another one, you will see that how the most of the growth happens as the policy goes more and more up in the years, the amount of the growth is way more because for example, in 10 years, whatever amount cash you have, it gets double. Now imagine at the beginning years, the amount of that cash is less. Therefore, the amount of the double is less too. But imagine it gets to the 100,000, 200,000, 300,000. So instead of increasing 10,000, it will increase 300,000 during the next 10 years, or even sometimes may get to 1 million in the next 10 years. It gets to the 2 million, right? The other reason, it grows with a much higher rate than other plans. All the other plans, as I said, they are going over the stock market and all those things, and all those plans that they are offering, they're not giving you way high rates of the return. But these plans, as they are insurance plans, they are covered by the insurance companies, and they are able to give the higher rates of the market to you. You never, ever, you can find higher rate than what an insurance company is gonna offer you. And it covers kids for their retirement. None of the college plans that you have, they're covering your kids for your retirement. And finally, it leaves a legacy for their own kids and their next generation. So this is because the amount of the money that they are going to save is increasing and increasing. And even though they start getting out of that for monthly retirement income, that fund is continue growing, although all this depends on how much money you put into that, how long you continue that, how much you get out of that, and all those things. But that's the good part, that it has the ability so that it leaves so much money into that one that can work even after they are not there for their kids too. So, do you know any other plans? Any other saving plans for kids that can work like that? As Will Smith said, do you have any better friend like that? No, you don't have. So I'm going to show you the illustration for a 13-year-old, and then later Anand is going to show you another illustration for a 10 years old. Okay, so let me explain to you this illustration. I made this one for a 13-year-old. I named it Dear Kid as the naming, but I set it in a way that the death benefit has been $150,000, and they pay monthly $150 continuously from the age of 13 that they are up to the age of 48, about 35 years, right? And during that one, let's see that how much they can save during all those years. Then I set it after that when they are at the age of, they don't pay anything after the age of 48. As I said, all these are flexible. You decide how much you want to pay. It is just a sample, and I may try to make it simplified, but you can decide how much you want to pay and how long you want to pay. So this one, by the end of the first year of the paying, it has this much amount. That this is the one that we are calculating. This is the one that historically, by the coverage that has been done by the insurance company, this is the account value, how much they have saved up to here, how much they have account value here, and this is the surrender value. At the earlier years, if you want to withdraw, you will get this much of the money, but you are always able to cancel, do not pay anymore, and withdraw the money that is already there. But for the first 10 years, it might be less than the money that you paid because it has some expenses, right? But then after the 10 year, the amount becomes equal to whatever you have paid, and then grow more than all you paid. Like by the end of the 10 year, you have paid 18,000, you have that 18,000. By the end of 20 years, you have paid 36,000, then you have, instead of 36, you have 58. By the end of 30 years, 54, and you have 139, and you can get all of that, right? And during all these years, you can withdraw whatever you own as the loan, and the plan continues to grow. And as you see, the death benefit of 150 is increasing as it goes by, although the kid doesn't need them. But as the kid gets older, when they get to the age of 40, is already have some protection for their family and pay attention that the death benefits are not only for the after death, they give them protection for themselves too, for anything that happens. By the age of 48 that they stop working, they already have paid $61,000. And that's only $61,000. What happens and how much they get for that $61,000. So first of all, by this time, they have access to 190 instead of 60, and it's growing. 280, 574, and is going more and more. At the age of, I plan this one to be after age of 60, they start getting 3,000 per month, total of 36,000 per year. Just by the first 2 years, they're getting back all the 61,000 that is here, they paid here. And look at the things that these are growing, the money is growing, and the death benefit that they need for the protection for the family is growing too, right? And it's continue. By this time, they already got 108,000 out of that. By the age of 73, after 60 years of the policy, they already have got 468,000 out of that, and they have 1 million, the whole account, right? And as you see, is growing 2 million, 3 million. As I said, in the last years is growing faster or not faster in the more amount because they have more amount into that. And as you see, if they live hopefully by the age of 100, they already have got 1.5 million out of these through the 3,000 per month that they have. So that was the things that I wanted to explain to you about the simplified types of the juvenile IUL. Now, Anand is going to give you another example that how we can max fund it. That one to get the most benefit to the maximum. Go ahead, Anand.
Sure, Nadia. Let me share my screen. I'll take care of that.
Oh, before Anand, before you start, I'm thinking, Blanca, do you like to share your experience that you had about your 3 kids that you got juvenile IUL for them? How do you feel as a parent?
I feel happy that my kids are protected and they have a plan for their future. I actually also hold my own life insurance with you guys, and and it's because last year wasn't a very good year. You know, with all this uncertainty, I needed to find out more how to protect my assets, and so I like the fact that I was able to have a plan with you guys that it was very personalized and tailored to the needs and kind of discover what was the right amount to go for. And depending on the wants that I want for the children is what we calculated. And it's within our very flexibility. You know, if there's opportunity to put more, I can put more. But there's an idea of the margin and what to work on. So I like that I was able to have the plan as to like what am I shooting for. It's not really that expensive. I think it's a great investment for the kids' future. And yeah, it's a great opportunity to save and prepare them for later in life.
Thank you so much.
Mm-hmm.
Anand, go ahead, please.
Sure, Nadia. Okay, so let me share my screen. So this is the second example which Nadia mentioned. This is another way of designing the juvenile IUL, which many of the clients we have done, which really has all that benefits like Nadia was mentioning, right from tax-free growth in this vehicle. Same thing, the money doesn't go down and stock goes down. and there's always that extra money. Plus, it's a flexibility of how we can use it, like an infinite banking concept, right? And also, one of the things, like Nadia mentioned, these are universal lives. That means they come with a lot of flexibilities. The one I'm showing this design right now, this is a case where, think about a scenario where instead of parents trying to put money in the piggy bank for kids, couple of $100 now, we can put into this vehicle. And in future, when they get a job, putting that savings habit early in life, we tell them, You put this much money, go forward." And how small amount put on the side can really build the nest egg. This is that example. And this is one of the designs where it allows up to like 150 per month, anywhere starting between 115 per month to like close little over $1,000 per month. So this is the annual amount. So what this means is these products have two types of flexibility. We call it kind of horizontal flexibility and vertical. Horizontal is we can save anywhere between this $150 to $1,000 throughout our lifetime. So that's one kind of flexibility. This is not like you're signing up for one amount for a long time or whatever. So that horizontal flexibility is there, and the vertical flexibility. We can save for 10 years, we can save for 15, 20 years, or even till people earn, they can save till they retire, right? So all the flexibility is there, horizontal and vertical. So one of the examples I'm going to show directly um, is this an example where a kid, a 10-year-old, a kid 10-year-old, we start saving like $300 per month, right? So till the kid gets a job up to like 23rd, age 23. So 300 per month, that's like 3,600 per year. And then because now the kid knows this is a great solution, and once they have a job, start saving like 600 per month. That's like 7,200 into their earning years. They decide at some point later, okay, I'm going to just work till 60 and retire, right? So this is that example where the other side, like Nadia said, okay, how do you want to use the full potential of it, right? So if the kid decides to save like $600 till he lives, because we are so used to paying mortgage, taxes, and other things, right? So this is a pay yourself first concept. And parents started early in life. Now, instead of parent leaving $1 million for them, started whatever they could, 200 per month, and continued that savings habit in kids. And whatever that small money they put on the side, guess what happened here? Over 50 years, they put 300K over 50 years, right? So that means there's enough time for money to compound, whatnot. So they will have around $1.8 million in their bank account if they want to just leverage the cash. But also look at the other way. We started something early during our earning years. We put something on the side. Can it take care of us till we leave, right? So there's one scenario where the small money parents started and the small money kids started saving later when they have a job. What it can give is if they retire early at 61, right? Starting 61, they can start getting 10,000 per month tax free. That's like 120K per year tax free, well into their retirement years. Let's scroll how long this comes. So this is a scenario where even if they live till 90, for example, right? So here we're taken till 91. Even if they live till 90, their $300 now worth like almost like $3.5 million. So and then after that, the kid is kind of the person passes away. They still leave a big legacy and go. See what happened. End of the day, it was 300K. It works enormously. Just because, as we know, there is no quick rich scheme in growing wealth. It's all about putting money, giving enough time for money to grow. Money has to grow in a better percentage, and that's what's happening here, right? So here we have taken a conservative scenario that too of money growing somewhere only around 6.54% compounding, not a simple interest. 6.54% compounding is like 18% simple interest. And insurance companies, whatever indexes we select, offer that kind of returns on this, right? And so this shows the value of starting early for kids, right? And building asset for kids. So wish we had some of this information while we were this young, our parents had this information. And also at the same time, the industry is evolving. So that's where we have all these great products like Index Universal Life with all these concepts coming in. So this is an opportunity for parents to start something early in life. And as you see, this was one of the example where if you're able to put a little more, like a $300, and kids able to do like $600, that itself will bring them build them a fortune, not just for them, which again, by the way, the 120K, this is just an example. If they wait, how much they can pull. Sorry, I'll come back to that. But they don't necessarily have to wait till retirement. It's not a retirement plan that you have to wait till 60 years and all that. Whatever cash you see here, if you go up, like let's say they're at age 50, or they're at age 40, there's whatever 420k sitting. They can use that for anything. It's their money. They can use it for kids college education, a down payment on a home, whatever. It's your money. They can take and use it, and it's all tax free. So this was one of those examples where we can really maximize the all the benefits of the IUL. And because they are kids, because we're starting very early in life, and as Nadia showed, it can be started as early as for a month-old kid, right? A juvenile insurance, and they continue to have that throughout their lifetime. So this is where it is called um, um, giving enough time for money to compound. All right, so it's all this product, particularly for kids, uses all those great concepts of wealth building, and that's where the amounts what we see are what we see. And again, these are again by the conservative growth. If the market really performs well in the future, obviously they will see more money coming into their accounts. But yeah, I think with this, I'll stop sharing on that. There are more technical details beyond that, but it's as simple as start early in life as a parent, let the kids continue, and they're going to build great wealth. And we are going to have all the solutions with the top companies, right? And they're there from 100 plus of years. They're going to be there for more years. And these are insurance companies. And insurance are the kind of the foundation, particularly for America. Though insurance companies are strong foundations. So that means we are putting, the kids are going to put money with some strong companies where not only their money is growing better, right? Like for example, they have this kind of cash. If something goes wrong, because it is insurance, that extra money goes to them other than the money they saved. No other financial vehicles gives extra money than what we have saved. And guess what? This is all tax free. So this is one of the great vehicles. So yeah, with this, I'll stop, Nadia. We can go ahead with the next slide.
Thank you so much. Thank you so much, Anand.
Thank you.
So as you see that we have all these plans available. So after this, I put the link for the, you can set a time, set a meeting by the calendar that we put the link for the calendar over there. You can book a time to have a session one-on-one to just go over. We can show you all the illustrations for every single one of your kids separately. And also, you can ask any question that you may have. You know, one illustration may have so many details in that one. Beyond this, you can ask any questions that you have. Just as the last sentence, I like to say one thing. As Anand says, we wish that we had such a thing. Just imagine that you yourself, do you wish that your parents had the ability to do such a thing for you, and you had access to such a money? So that's the way that your kids is gonna feel in the future. So the small things that you're gonna start saving, it can help your kid a lot. That's, as you have seen already some, that is a lot, a huge difference between being worried, being in debt, broke, and all those things. They can have a lifelong financial settlement and stability and freedom. Just think about that one. At least listen and search for the better options instead of just sticking to whatever you get used to use. Thank you so much for your watching, and we hope to see you soon.
Thank you.
Nadia, awesome.
Thank you so much.